Hello and welcome to a special 2025 Outlook series of conversations and interviews on the Core Report. There is a churn happening in the Indian equity markets, and you've seen that, not unlike before, but the coming year could see some sharp shifts between sectors, for example, like automotive losing favor and financials continuing to hold fancy. On this Core Report special edition, I speak with Samir Arora, the Singapore-based founder and fund manager of Helios Capital, and amongst the oldest institutional investors in India. Arora moved in 1993 to Mumbai from New York as Alliance Capital's first employee in India to help start its Indian mutual fund business. He also managed the ACM India Liberalization Fund and India Dedicated Offshore Fund since its inception in 1993 until August 2003. He started Helios in 2005. I asked Arora in today's conversation about the major trends that he's seeing in the markets in 2025, areas he finds interesting and does not, and what has made him money in 2024. And finally, what is the stock that he invested in a decade ago, and perhaps even more, and would still do so? Samir, thank you so much for joining me. So before we jump in and we look at both what happened in 24 and more importantly, what you're seeing in 2025 as investing trends, let me start by asking you about what was the most, in your estimation, the most exciting buy call and most exciting or rewarding or satisfying sell call in the last year?
So for us, we had two good calls which made us a lot of money. One was Zomato, and the second one was not panicking on Paytm when it fell a lot and believing that some of those things were unfair and unreasonable and adding more and then making like 2-3 times from the bottom. But overall, so these were two ego satisfying and NAV satisfying trades.
Okay.
But we also short. So our big short, by the way, we are still continuing it after nearly a year. Are the auto guy in India, the big auto guy. Name I don't give for the shorts like I give for the long. On the basis that the auto industry is basically screwed. So basically the investments required in this EV game are too high. And you can see even today's news about Honda and Nissan and all, but you can see all the other global majors all cannot handle the capex required for transitioning to EV, the investments required. And for the Indian guys to do it at their small scale is just because they are protected a little bit.
Right. And you're saying that you're saying that Indian consumers want electric, Indian automakers are not able to ramp up, and therefore you're not seeing the potential?
No. The thing is that the consumer wants me because consumer is being led to believe that he wants, but the companies had to make big investments to transition to the new requirement of the world, which is that you need to have EV cars. But when you transition from your normal car to EV car, nobody's saying that the number of cars sold will be more once you make it into EV. So basically, you are spending these billions of dollars for basically the same size of the market, other than the normal growth of the market, which was there, even though, like whatever, say 5% per annum. So you are making this investment basically to remain in place. But the second thing that has happened is that there were companies who were not making IC cars, who when the transition happened suddenly said they are also interested in making EV cars. So the number of players in the industry have gone up, but the size is the same as before other than the normal growth. And everybody has to invest. But the new guys investing have different horizons. They are maybe private equity funded. They are unlisted. They can say, I'm taking a 5-year view. I've just started. Whereas the listed guy who has to show his performance every quarter or whatever has also to simultaneously invest a lot. It's basically a capital destroying business, according to me, not driven by economics, but by society or climate or whatever. So obviously it is like an external thing. You say, okay, do this before you can sell. So it's economically a bad business, but it is required by them.
Right. So, and that's a point let me pick up on. So this was, let's say, almost a sectoral tectonic shift driven by, as you said, external factors, including changing perceptions about climate, how much
requirements of society wanting it or governments wanting it or whatever. But not your own driven thing.
Right. And what else do you see happening? I mean, what else is on the cusp of that kind of change among sectors and businesses that you
Or for
track?
example, even our good old, which also we are short, but there's only one company, so I don't want, which is the multiplex. It went disrupted. Now, there's no point in saying that Pushpa will be a big hit or not a big hit. By the way, this is the reason given for people to buy this stock. That this month there is advance booking, not realizing that the sector has been disrupted out of shape. And so when we were discussing this with the sell side guy, he was saying, "Oh, but you know, Indians have to go to theater, I mean, to movie theater because what other
Yes.
entertainment they have and stuff like that." The point is that normally a movie going audience growth is population related. Let's say 2% per annum
Hmm.
because whoever wants to see can see, and maybe there is some growth. So if for this disruption, only 5% people say we are not seeing as many movies. That's like 2 years of growth gone.
Hmm.
And
Yeah.
actually, it's much more than that. It's much more than that, I think. And it's a worldwide thing. So there are like these small, small things you will find all the time. We are talking about our short side of our portfolio, but most of the money is made on the long side. This is, as we call it, eco boosting shorts.
Yeah. No, I'll come to the long side in a moment. But if I were to look at these two trends, I mean, are you seeing anything similar or overlapping, at least in terms of what you can take away? One, let's say, caused by climate, society, and all that. Second, caused by the way we consume content, which is also in a way societal, but
Yeah, yeah.
driven by, let's say, technology, streaming, and all of that.
Correct.
But is there anything common that you see?
Yeah,
Anything?
yeah, there's even more. That's why there are many more things being disrupted. I mean,
Hmm.
actually, if you look at it, everything has got disrupted. In the West, cornflakes, which initially people would have thought that breakfast, you will always have the same, how that is basic food. And then they say, oh, there's sugar. So sorry, that got disrupted by healthier foods. In India, the story is that these consumer companies are getting disrupted because private equity and maybe whatever rich promoters on their own or their children are making sub brands for small small things. Somebody is making for you know uh, personal products or consumer products or cosmetics. Somebody is making potato chips, whatever they
Hmm.
are doing. Basically, you are making small small niche competitors to all these big companies who were previously supposed to be making these. So that's why this has become a tough game, because basically anything can be disrupted. Literally anything can be disrupted now. Or, I mean, quite a few things can be disrupted.
And in this case, you're saying the disruption is coming from the ability to produce, let's say, cornflakes or some other consumer-facing
No,
product.
cornflakes got disrupted because of health. Because people
Correct.
suddenly, it's not, it didn't get disrupted. I'm just using the word. What I
Right.
mean is something which was long standing to be always, basic food. How will American will keep eating? It got disrupted means that suddenly the one feature came up and that feature became important, that it is sugar or too much sugar, or this and that. And suddenly a healthier alternative. In some sense, Subway came, I think, as a thing to McDonald's that, okay, you get fresh food or whatever. In cosmetics and all, you are basically disrupting because you are segmenting the market so much that you are saying I can do it for this audience which wants this and that, and the big guys are not able to
Hmm.
react with the same
Correct. But,
agility.
let me, if I were to, I mean, maybe ask you to put your MBA hat on for a moment. So you have disruptors who are coming in. So let's say in personal care or foods, and we're seeing that flowing through Amazon or Flipkart and so on.
Correct, correct.
But do you see their unit economics sustaining? Of course, they may cause damage to the levers and the Nestle's in the short to medium term. But do you see those unit economics sustaining beyond a point, or do you
So
feel that?
I read a book. I read a book. I forget the name, but I tweeted on it about 2 3 months ago. Basically, saying that it is easier to say with new technology. In this case, it may not be technology, but whatever. That who the losers are rather than who the winners are. So, for example, when in that book it was that when you had these in the olden days transportation being done by the riverways and all that, and then the railways came, you didn't know now which railway guy will do well because they all were running with different tracks from Chicago to New York and somebody from here to there. But you knew that collectively they are going to destroy the existing guys. So for us, the good thing is we are not private equity guys. We don't care. Because when they go public, that time we have to analyze them, that are you making profit or not. Right now we know that we have to remember that when we are looking at our listed companies, because normally what happens is you compare listed companies with other easily available companies, which are listed companies data, that in every sector. So we tell our analysts ki please yeah, at least check from contacts, because private equity funded below the radar companies are being formed, and who knows, like it happened even with batteries. Because listed there are two companies, Amar Raja and this other one, apna Calcutta wali. But then there's so many other guys trying new technologies, this, that you have to remember to worry about disruption these days. Previously, it was okay, it was not this company, it was that company, which are all listed, and it was just an easier comparison.
That's interesting. So when you, in your holdings, and I know you have an elimination framework, as you call it, in your current large holdings, are you, from a research point of view, looking to see what could be disrupted? As in actively looking to see, okay, I have a very large holding, let's say in a Levers or a Nestle, just as examples. And I, as a research person or a fund manager, I'm constantly looking to see what could really affect
Yeah,
these.
yeah, yeah.
Yeah.
So basically, that is one of our 8 factors of elimination. So the difference is not that we know it is getting disrupted and the other guy doesn't know who's buying it. The difference is that he will say it is getting disrupted, but it will take 3 years.
Hmm.
And currently, Pushpa is about to be released in the theater, and their advance bookings are very good. And we say no. In those 8 factors that we have, of which one is disruption, there is no trade off. That means we also believe that because the new unlisted guys are competing, let's say in two-wheeler, the market has got divided because new guys have come in, like Ola has come in, Ather has come in. Now, whatever they sell, ultimately it's from the same universe where the older guys could have sold. But somebody will say the rain is very good, so the rural economy next 3 months will be very good. Therefore, 3 months scooter sales will be very good. It's not that when we say something is getting disrupted, the guy who's bullish on those stocks will say, no, it's not getting disrupted. No, he will also agree. But he will say the window is different. He say no trade off. That's the only difference.
So, one point that you've said consistently now is that most of the sales, whether from the disruptors or the existing players, is flowing into the same universe of consumers who are growing either at a small percentage or in a small way.
No, correct.
Come here. So, if we were to now look on the other side, which is the demand side, how are you seeing that right now and going into the next, let's say, first half of next year?
Low. So that's why, for example, we own Zomato and Swiggy and all, where we are not relying on the end growth of consumer demand and his income so that he is ordering more food. No, no. It is a change within his buying habit, that instead of buying from here, he's buying through the consolidator or this
We.
thing. The end growth, we hope that after 6, 9 months it'll come. Because the big picture logic is that economies and these big masses don't move within 2, 3 months. So if recently only the disappointments have come on consumption and consumption growth, it can't suddenly change in 2 months.
Uh-huh.
It will take 6, 9 months when the base will change, some confidence will change, some tags will change, something will happen. Suddenly, because the logic is that if somebody recently disappointed the market, that is some consumer company, let's say, and they were previously not disappointing, or they were previously trudging along on a normal whatever low pace or a steady pace,
Hmm.
they would have tried very hard to not disappoint.
Hmm.
So when you disappoint the first time, if you think that is going to be okay in 2, 3 months, then you will basically be able to get over that quarter by jugglery or commentary or whatever. But when you say it is slow, that means abhi 6 mahine gaye.
Hmm.
Otherwise, 1 quarter everybody can handle. I mean, handle means they will be able to fudge it, if that is the word. If it was only a matter of 1 quarter, that means you have really thrown in the towel a little bit by talking negative, and they all talk negative this time. So it can't change according to me 2, 3 months. When the base effect happens, or some new trigger happens or the budget has some cuts or something happens to generally bring a little bit more excitement. So I think it's gone for 3 6 months. These consumer type growth, consumption type growth of the kind we have seen now, these guys grow at 3%, 4% volume, both driven by end demand and competition. Like in paints, now another big guy has landed up, and if the end growth is very normal, like for 5 6 months, but yeah, but then you have one more big guy wanting to give discounts or making his entries. That's what I was saying in all these. I believe the same thing in consumer durables. So people say that uh, middle class, so they will all buy fridge and TV and they will all buy ACs and microwaves. They will all buy, but on the other hand, they will all make also. Now everybody wants to make,
Hmm.
from Chroma to Reliance to Flipkart. They don't want to just sell they want to make it. So it's a tough environment.
So, how do you then, I mean, or rather, not how, but when you assess companies, let's say traditionally you assess companies on the strength of their product, distribution, brand, marketing, and so on. But in an environment when, let's say, the market itself is not growing
Mm.
as much, you're really assessing a player, if you are, on the basis of his or her strength to dislodge someone else, which I think is
Yeah,
a little different from, let's say, being a steady, solid player. I don't know if that makes sense.
I agree. So therefore, our consumer stocks, we have very few and we are more short than long on consumer, because it's this consumer sector where the consumer sector always had very high valuations.
Hmm.
Okay. And these valuations went up even more in this bull run. But their growth rates are not even double digit. So
Hmm.
their growth rate is lower than our GDP growth. They are not growing at 7% in volume.
Yeah.
So that itself is unappealing. So beyond that, you don't even have to do much, because they themselves are guiding that if we will have growth, it'll become 5%. Who the hell wants that? But in general, the toughest thing these days is consumer. I agree.
So, in which case, if you're now looking for, let's say, new bets in a economy where most companies are not able to grow beyond a certain point, at least right now, 3 to 6 months or 9 months, what is driving your investment approach?
So our biggest thing is in financials,
Hmm.
where if you see, other than those who were focusing on or had a share in microfinance and personal lending, basically these other guys have done well. So the bigger have done even better, like the banks, private banks, even some of the NBFCs, capital markets, for whatever reason, they are booming. So that is also a good segment, these DMAT guys and the brokers and all. Second thing, which is on the margin doing okay, is IT. It's not that they are also growing at 15%, they are not. But hopefully they are going to say higher than last year, higher than last quarter, because of basically US having the confidence and the growth rate. And if S&P 500 is doing well, those companies are confident and then they, are growing. And so that is the second. But our real money has been made in buying these newer age companies, which for us there are four and all have paid rockets, which is why our NAV is up a lot this year, which is the Zomato, Swiggy, Paytm, and the PB FinTech. Basically, in all of them, you can say that the end consumer demand may be low, normal, whatever, but the shift in usage
Right.
or from one to the other is the next 1 or 2 year story. By then, hopefully, the end demand also becomes higher and also spreads across different segments.
So I know retrospectively or otherwise, in some of these cases, the stock prices have done well. So in that way, your faith or your investment is already.
This has been very good because of that. Yeah, we are
Yeah.
massively
But
beating the
on the other
market.
hand, if I remember, anyone who was of your vintage would not have typically invested in companies like these, which are obviously steeply loss making.
No,
So
no, no, no. It's not like that. This steeply loss making, those days are gone. All the companies of the world which have done that are loss making. So the thing is, you have to believe that, and one day they will make a lot of money. And that, as you said, unit economics are good. Now, actually all of them are making money, but not big money. And of course, part of the reason is they all have cash. So they are earning on the interest. But basically they don't need money from you to grow. It's not a loss making company in the sense that, oh, if I don't get funded, I will not be able to grow, because they're self sustaining, because of also the fact that they have a lot of cash in their books. Like
No, when I
Zomato
say
guy has now
when I
maybe
say
20,000
loss-making,
crores or something.
yeah, but when I say loss-making, I mean accumulated losses.
But accumulated losses are right now.
Agreed.
The game is that and cumulatively for us also, these are only 15% of our portfolio, but they have given us
Hmm.
maybe 5% performance out of that 15. So the thing is that at a portfolio level, every fund manager wants at least some 5, 10, 20% where he can dream of 20% revenue growth or 25%. That the number of stocks which are offering that has become very limited this year. Therefore, I said and I still say that these stocks are in shortage because every guy will want some of that. They can't all grow, live on the old consumer guys growing at 5% and trading at 50 multiple, saying, I don't want a loss making company, unless those companies corrected a lot. So, as a portfolio, it makes sense. Individually, somebody may say it's too much, too whatever, but having 12-15% combined is okay. We are going to keep it and enjoying it.
Yeah, and that sounds fine from a risk point of view or a portfolio construction point of view, which you also talk
Correct.
about as Helios. But I mean, personally speaking, has this meant a transition for you too, in as a fund manager? Let's say the way you look at stocks, and that's going to be my next sort of forward-looking question as well, which is that is this are you looking at stocks differently now, and the way you assess? I mean, for example, if there are 8 factors, have 1 or 2 factors changed almost permanently
No.
because of
So
what's happening on that?
what happens is one of our factors is valuation.
Mm-hmm.
But the valuation does not say that it should be profit making. You have
Hello.
to say valuation, does it make sense? So you will say it makes sense relative to the US company. It will make sense relative to the growth rate. It will make sense if I move my year from 26 to 27. It should make sense on some of these. It doesn't have to make sense on PE or something. Because the valuation, for example, we in the olden days bought Westlife, which is McDonald's India franchise. Okay.
Uh-huh.
Franchise means he's a franchisee for West and South. Now that fellow makes losses.
Hmm.
So how to justify? And he
Yep.
actually literally more or less never made money, but the stock does well and we own it since like 2014 or something. So we said that you are getting half of McDonald's India franchise for at that time some $300 million.
Hmm.
Okay, now it's become a billion, I think, or something. So we said, okay, let's see all the other MNCs and what their Indian subsidiary is valued at. Of course, those are subsidiaries. This is only a franchisee.
Yeah.
Okay, so make it double. That means 50% weight for the fact. So, okay, it's therefore, if it was a direct McDonald's India, it would have traded at maybe double the valuation, let's say. So, therefore, calculate like that. And we said that in the Indian businesses, that is Westlife and the one which is in North and East, together are valued at some 1% of McDonald worldwide market cap. But Nestle is trading at so much percent, Lever is trading at so much percent. So we said they're all trading at 10-12% of the parent's market cap. Here is trading at 1%, even if I double the valuation. Therefore, it's very cheap. This is my view of it is cheap. There was no profit. So what I mean is, you have to have a model for each to say, can I call it some kind of value? It's like because it was listed, you are valuing it like a private guy would have valued. But actually it is listed. So for us, we could buy it. So what I mean is, even in all these, you can justify in all of them.
Hmm.
You can justify all of them if you believe and it works out that there is growth rate for a few years of the magnitude that it is currently having, which is 30-40%. Yeah, 30% kind of thing. For these other ones, I'm saying, not Westlife,
Yeah.
for the new areas.
Right. And let's come to valuation then, since you've touched upon it already. So 24 has seen obviously the stock markets do well. Even though there's been a knock in September, we've also
Correct.
recovered a fair bit already. And things look somewhat steady. I don't know how steady, but I want to put that question back to you. But where are we today in terms of perception of valuation and in as a market overall? And then I'll come to one or two specific questions within that.
So the thing is, the if you look at the large cap company, which is Nifty, so Nifty's returns, if you look at for the last 3 years, are something like 14% per annum. And if you look at it for the last 7 years and 10 years and 20 years and 25 years, they'll be 14% per annum, plus minus, 13, 15. If you look at the 500 index, which is the more representative index of the overall market, then last 3 years returns might be some 17% per annum. Okay, and longer term will be again 15ish.
Right.
I'm deliberately not saying last 5 year return because they look very high.
Yeah.
Okay, but last 5 year, who said that you have to look at 5 year? Look at 7 year, again they'll be moderated because the 2 years prior to the 5 years was very low. Okay, but big picture here ki the Nifty index is more or less returns are in line with history, and the 500 index is say 2% per annum more than history for 3-4 years. So cumulatively, even that 500 index may be 10-12% more than what normally you would expect. But who has to say that literally every year it has to be like that? It is not so wildly off that you say, my God, run away. Because this 10%, let us say that you are supposed to go back to longer term average. Does it happen smoothly? Does it happen in 1 year? Does it slowly, instead of growing now 14, it grows 12%? Who's to say? But it is not wild. But what is wild is a few small and mid cap stocks. But that also few. There was a report from Kotak Securities about 2-3 months ago saying that of the 150 stocks which are called the mid cap stocks as per SEBI, which is 101 to 250, some 25 stocks were responsible for more than 50% of the move of the index. And the balance may some 38 stocks out of the 150, or the total 150, were negative or below 10% return. So कहने का मतलब है even there 20-25 stocks, particularly these Zomato types, even there's our fintech and all, who have gone up 100-150%, the trend has gone up and all these. It's not the average. This year, the Nifty for the full year, which is nearly getting over now, it is up 11% this year, right now, 11.4. So it's not wild. Plus, we have not had FII flows. Normally, FIIs buy. If you look at the history of the last 20 odd years, there are only 4 calendar years in which FIIs have not bought net. So their normal starting stance is to buy because they also get flows. The emerging market guys get some whatever piddly amount, but everybody gets the proportion of from the world. And so I think the returns next year cannot be as high as this year because this year, like we are up some 28-30%, which is not normal when the. But to say without being sure, but to say you will get mid-teen doesn't look so wild also. Maybe you get it in the second half and the base effect is okay. This year, please remember that April 1 to September 30th, basically nothing has happened in the country in terms of pre-election and then election and then no spending. So next year, first of all, this quarter and the next quarter, government will have to spend a lot because they will blow up their whatever budget money they have. And then next year, first half, we'll be comparing with this low April 1 to September. So 6-9 months are okay because first 3-6 months is government spending and then next 6 months is comparison with a very low base.
Right.
By that, the world would have moved on. Who knows?
So just speaking to valuation now, I mean, so you talked about, for example, sectors where they were overvalued for even though the growth was not, as strong or as robust.
Particularly consumer types.
Correct. So now, so there is a reason for that. I mean, one is of course the let's say the pedigree of these companies, the parentage, the quality of management.
MNC.
I'm assuming that's one reason. But I'm really asking you, I mean, what are the other reasons why companies will get valued, or how companies will get valued as you look ahead? And what would be your own benchmarks or red flags, which are perhaps old ones as well, as in when you take calls, particularly longer term calls?
So therefore, on consumer, right now we are only buying these newer type companies. Like you on Zomato, we call consumer. Swiggy, we own this Varun, which is a Pepsi bottler,
Hmm.
and Westlife, which is the McDonald franchisee. But we are not buying those old shampoo type companies and soap companies, and neither are we buying the consumer durables. So there's another story with the shampoo and this thing, which is that previously the story was that if there is rain, then rural India will get money and they will upgrade their toothpaste or they will brush once a day. But now I think even their uh, basket has changed of what they want to do if they get money. Maybe they want to take camera or a phone or a photo on Instagram or God knows what. But it's not necessary that what they're doing inside the house, they would spend money on that first. Also look at it, that when these telecom guys announce that they will hike prices, like Bharti and Geo did.
Geo.
So let us say they do only 30 rupees per month. I think this is what they did. That is 30 means 360 rupees. And how many consumers are there prepaid? Maybe 80 crores, pata nahi 100 crores. So if there are 80 crores,
Total smartphones is about 800 million. Yeah. But I don't know
80
how many
crores.
are active. Yeah.
But mostly it's prepaid now because
Yeah.
they're. So even if it's postpaid, their price also went up. I mean, generally,
Yeah.
so
Yeah.
you have taken away from the consumers 30, 40,000 crores. It looks okay, you're only taking 30 rupees from each fellow per month, but 360 into 80 crores. So 25,000 crores. So one budget, something that you give to the public is only this much, and you took it away in one.
Hmm.
Therefore, we think that the old consumer companies are challenged because the preferences of the buyer have changed. Plus, there is competition. Plus, they always had high valuations. Their growth rate on their own guidance, even if there is a turnaround, goes from 4% to 6%, which looks very unappealing. That's why we don't buy the old gang.
Right. So as you look ahead, we touched upon auto. You've pointed about, I mean, the disruption theory and how that could be actually far more pervasive than we think it is. What are you seeing in 2025, which could be different from 2024? Also, because we have the Trump factor, which is surely going to affect businesses and trade and so on.
So Trump factor is positive according to me for India, because if imagine if it was Kamala Harris, Kamala, I also say Kamala, and she would have increased capital gains tax, then our government guys would have been licking their lips saying, oh, if US can increase capital gains tax, you think I can't do it? But now they will all realize that, Trump is going the other way, so he'll keep our this thing also in check. Plus, my second thing is that I think he's not going to fight with everybody.
Yeah.
If he's going to fight with China and all, he's not going to fight with India so much. Because Indians are otherwise the nice guys and all that. So overall, it won't be a bad outcome for India. I think that we should not worry so much. Plus, if the US market is good,
Hmm.
we may underperform that market, but you don't become negative. Which was why I was very bullish from even in October, saying it cannot be. If US is up 10% and we are down 10%, that is an unsustainable this thing. Because in the end, if the guys are making money, the fund managers, the investors, the endowments, then they will do average from here. Ki chalo, wahan pe you made 10. So after, maybe not today, but after say Jan, Feb, and they see exactly what Trump does, and if they find he's not really going all or against China, all those things will change a little bit. So US doing well is what is good. It's not a competition. Yeah, we are nowhere near to compete with US on these things. That US, because US has 65% of the index, we are about 1.
Yeah.
So people say, what happens if US goes up? I say, US goes up, they are 33 other percent from where, or 34 they can get from there more money if they want. Why are they looking at my 1% weight?
This is the MSCI Global, or?
Yeah, sort of MSCI Global में India में 1-2%. and US might be even 70 or something like that these days. So
Right.
this idea that US is doing well, therefore they will take out money from India, that is a small piddly amount. It's not an equal game to have this.
So, from what I've gathered from what you've said, you're seeing 2025 being somewhat consistent with the themes that we've seen emerge in 24, and with some obviously expansion and growth as the case might be. So,
So
which would
little bit,
also
I think little bit the change might be that some of these investment type stocks might also do well if government is now seen as having, kick-started the investment which were missing from the last 6 months. Now you can see already announcements in defense sector and all, which is happening to these PSU companies. And those stocks have done well. Like from the bottom, they might be up 15-20%. So it's happening a little bit. So that little bit change might happen. And we also want the market to be a little broader. And for that, these IT guys giving a positive story in Jan would be also a useful thing. So we have to wait for that. But it is not that it's some runaway market. But even if you make 10, 12, 15% and it's considered as consolidation, well, nothing wrong with that after so many years. But there's no logic for it to be down 10, 20% for no reason. That's right.
yeah. And you mentioned PSU. So, you're not seeing any stretched valuations there like some others are?
No, so we are not owning many PSUs now
Okay.
because PSUs have two story. I mean, you need two things for the PSU story. One is that they should be cheap, and now you are right, they are not. And secondly, the government should be seen as saying now change this style of working. So that also they have done in the first round, but after that doesn't look as a big reinforcement of that. For example, prior to the election, I was dreaming that BPCN will be privatized because there was some logic I had made, which I think was logical.
Yeah.
But वो
Well,
सब अब चीजें छोड़ दी हैं. So therefore now it is neither very cheap, neither there is some extra action in terms of some. So now we still own 3, 4, but we don't remember them as buying because they are PSUs. You're buying them because, okay, like State Bank is cheap and good and all that. Or we own these NTPC because of power may have. But if we are not looking at it, that we are trying to fill a allocation of PSUs. That's the difference.
and that's a good point that you've brought up, Samir, that the expectation that there would be disinvestment or more disinvestment,
Oh,
investment
so
into privatization. But clearly, the current government has no plans or desire to
no,
do
no,
so.
no, man. It looks that will be a
Uh,
positive surprise if it happens, but
yeah.
doesn't look like. But there's no talk of it, and there's no. Yeah.
But you're saying that as an institutional investor, this was somewhere in the back of your mind when you invested to the extent that you did in some of these stocks, or even considered it.
Oh yeah, but last 1 year we did very well. Or everybody expecting the
Yeah.
similar things, and then but we were after election and after budget, so we reduced our PSUs because for PSUs you need continuous dream selling.
Right.
So if you didn't sell more dream, then we are okay. That's why we went into IT then after that.
So, last one or two questions, Samir. So, between asset classes, we've obviously talked about equities all this while, and equities has done well, and you've defined or described how you think it'll do in the coming year. How are you looking between asset classes? I mean, gold,
We
as we
don't
all
look
know.
in our job. We are only India equity managers.
Yeah.
But if you ask me personally, I think everything I have bought everything after Trump won, which is India, China, gold, and US.
Mhm.
Everything will do well according to me. Yeah, because gold will do well because they're still worried about Trump and what he does. US, of course, is liberalization and deregulation and M&A and generally. And China, I think in the end, he's not going to do this full thing because even yesterday he said Tim Cook went and met him, so these Apple and is guiding, not guiding him, but trying to influence him. And then, of course, Elon Musk has a big business in China and all that.
The
And at the end, he's
largest
the
manufacturing in China.
huh?
Tesla's largest manufacturing plant is
Yeah,
in
and
China.
the Treasury Secretary is an ex-hedge fund manager, Scott Bassett. So whatever the Bennett, whatever the Bassett, whatever. So all these guys are not going to suddenly say, okay, put 100%, 20%, 50% tariffs on China. So I bought all the four, but order of preference would be US, India, gold, China. Because China is a little bit of a punt.
Got it. And the other thing that affects or influences market to some extent is obviously flows. You've already touched upon foreign portfolio investors. How are you seeing, the big case that was made in the last couple of years was the strong
Yes.
domestic flows, including through SIP, systematic investment plans, mutual funds, and that route, plus maybe some more avenues opening up. But how are you seeing that?
So
And
we are also now in the mutual fund business. It's
yeah,
crazy. Every day we get some 700-800 new guys investing. And we are getting 700 people, must be getting maybe 1 lakh, I don't know how much. But every day they come, from where they come, and we would have already got, I think, from 400 cities. Now, where they discovered us, how they discovered, because about 40% of the money we get is direct. In the industry, supposedly it's 20 odd percent direct and 80% through distributors. And for us, it may be 38-40% direct.
so when you
So
say
they
direct,
see
come to your website or
mutual. Yeah,
hmm.
yeah. That means they are coming to our website, or they are going to Paytm or Zerotha or somewhere, or
So that
Money
you call that
Control.
direct or do you call that through distribution?
No, that is direct, means he's just basically directly buying. What I'm saying is, where in these 300-400 cities they heard about us, who knows, and they buy on their own. So this, and of course the NAVs, not only ours but the industry's NAVs are doing well, and they haven't really seen a bad, like, longer period. Only maybe October, even there we were down some 2-3%, 2%. So generally right now there is reinforcement in the eyes of the in the minds of the customer or investor, because every time he's bought a dip, the market has gone up. His behavior is getting reinforced. If he buys once or twice and then it falls 10-20%, then only we'll say maybe this trade is over. Right now, actually, on the days the market falls, the flows go up 100%. I can see it now direct. Yeah, they go up. So that's why right now it's not a bad thing. But the other thing good is the market has not gone overall totally out of control. If you want to know what is out of control, let me tell you. So in the years 2004, 5, 6, and 7 calendar years, the 500 index went up 39% per annum for 4 years. Now it has gone up 17%, and we are saying it is very. And in the year 1999, the NAV of my fund, which was the Alliance Equity Fund, the NAV went up 280% in 1 year. So that is what we call a bull run. This is a baby bull run.
So 99, that would be your tech, whatever the
No, it
dot
was my
com.
normal fund,
Okay.
but driven by tech.
Oh.
Alliance Equity Fund, which is now
Okay.
Birla Sun Life Equity Fund.
Yeah. So,
So point is, bull run का मतलब अलग होता है. ये 17% को, why we are all calling it a bull run? Even 4, 5, 6, 7 for 4 years was 39% per annum.
and you're saying the base, of course, which is much higher today, that should not really be the.
No, no, of course it is, but I'm just saying in those 4 years the
Yeah, yeah.
returns were like that.
Okay.
Obviously, the starting valuations were high, that's why it did happen. But still, the point is, a bull run is a bull run from wherever it may have
Wherever it stems
started.
from. Yeah. So,
17% is a few percent more than normal return, which is 14.
right. So, last question, Samir. So, if I were to, and you could give me a slightly detailed answer if you wish, what's the one or two stocks that you bought, let's say, 10 years ago, or maybe even 20 years ago, that you would still buy and why?
So we actually hold one stock which we own from 95, which is HDFC Bank. And it's still a number one holding. Okay. And all its life has not been number one, but all its life it has been somewhere in the top 3-4 names. And it is what we call high confidence in reasonable return. The confidence is high, but the return will not be 30% per annum. But hopefully they will be, I don't know, a little bit more than the market. And the market, as I said, been maybe
17.
12-14%.
Hmm.
No, market is 12. It has been 17, but I'm
17
saying,
this year. Yeah.
so if it gets 16, 18, it will be great. Who knows? But the point is that the confidence is high because they are doing the right thing. The stock has not gone up for 3-4 years because of change of management and the takeover of HDFC, a merger of HDFC. Those things are getting sorted out. And in recent months, when the issues of this lending to unsecured lending and microfinance came up, the most disciplined guys turned out to be the same old survivors. So just like me, I say for myself, in our business, to survive is to win. HDFC Bank, if you see in the 90s, how many banks were there? Global Trust Bank, Bank of Punjab, Centurion Bank, 20th century, पता नहीं कौन से बैंक थे, RBL, Yes Bank. To survive is to win, and survive with dignity is to win even more. So these guys are a very easy way, which we bought many years ago, and we still buy when we get new money. And then you send us new money, we'll buy again. So please send.
Samir, it was a pleasure speaking with you. Thank you so much.
Thanks a lot.